Hi, I'm Keith McCullough, and welcome to the sixth. I just asked the team about that. The sixth Hedgeye Investing Summit. This is the place where we have 9. I think we're going to have 3 today. We're going to have consecutive conversations with the real people who are, number one, macro aware, and 2, can add a lot of value to what it is that you do, whether that be help educate you or get you up to speed on something that's actually happening in markets. This is one of my favorite gets to talk about that, as opposed to what should, could, or would happen in economies and markets. She's empirical, she's data driven, you got a lot of things going on for you, and you get to sit in that beautiful home with that nice backdrop. Thank you for joining us. You're the leadoff hitter this year. You earned it. Hedgeye Nation salutes you, and welcome.
Thank you. It's always nice to be here with you, Keith. I like it in person, but given that I don't live in Connecticut anymore, this may be our future.
You got the better trade on that side. The first thing I want today's an interesting day, of course, because today was the day that the Dow was down like 12.9%, second worst day in the history of that. Again, like as I mentioned, empirically you have all the look backs. I think that one of the things that I appreciate most about your work is that there are a lot of numbers in it. I mean, I read a lot of narratives, and in fact, it's kind of easy to stop reading because there are no numbers. There are things, like I said, the way that the world should be, could be, bubbly or not. But again, you put this in the context of the cycle, and maybe take a step back if you could, it's only a year ago. I mean, in cycle time, that's not a long time ago, and maybe take a crack at where you think we are today.
Yeah, so it's amazing, though, the condensed period of time that we've gone through what effectively is a full cycle. And I think the condensed nature of the bear market was driven by several factors. The obvious one that we all talk about is the sort of double-barreled stimulus coming out of the Fed and Congress, which is certainly what differentiated the reaction to the COVID crisis from the financial crisis. And what a lot of people, though, don't remember is that the timing of the bottom last March 23rd, I think we're tied to 2 things. One, not so much what the Fed had done up until that point, which gone to zero interest rates, relaunched QE, but announced some of the backstop lending facilities even before they were set up. So it shows the power of their words. But maybe a less discussed force, I think, that drove the market to bottom when it did and surge so dramatically was that was the last week in the quarter. So a lot of funds, mutual funds in particular, do the rebalancing the last week of every quarter. And if you think about what had happened, let's say just using simple numbers, you like numbers, Keith, and yes, those are my dogs in the background, even though I have a sign on the front door saying, don't ring the doorbell, don't knock, typically for UPS, but I think somebody must be in the back. So hopefully they'll calm down soon, or we're going to have that lovely dual lab barking noise. But simple math, if you were, say, a 60-40 fund, and you rebalance to that at year-end 2019. So you rebalance the last week in December of 2019 back to 60-40. Fast forward to March 23rd, leading into the last week of the first quarter, you were maybe 48-52. So I think there was a rebalancing trigger that also went quickly into the equity side of the equation. Then, of course, we've had several phases in the rebound. The first 2, broken up by a little bit of a corrective phase in June, were what I've been calling sort of concentrated recovery. So the dominance of the big 5 at the expense of pretty much everything else. And that persisted until early September. Then we had a bit of a rotational corrective phase in both September and October. And then by the end of October, early November, certainly in conjunction with the Pfizer news, we got that broadening out down into the more cyclical parts of the market and the economy, into areas that had not performed, energy and financials. That gave a fillip, obviously, to value indexes, which have a much greater portion of them are in those sectors. And then rolling into this year, we started to see what had concerned me really since last August, some of the speculative froth. Back in August and September, it was more concentrated in the big 5 into areas that were otherwise leadership areas in the options market, but you weren't seeing it pervasive across other measures of sentiment. But starting this year, sentiment became pretty frothy across just about every behavioral and attitudinal measure of sentiment. And then, of course, the flash mobs decided to move into more speculative, less quality-driven segments of the market, be it heavily shorted stocks or non-profitable tech companies, down into penny stocks, into SPACs. And I think we're in the process of seeing some more of this just rotational corrective phase that maybe eases some of that excess without the entire market coming down along with it. That would obviously be the most benign scenario going forward to ease some of the speculative froth versus, say, a early 2000 kind of situation where just the bottom falls out of everything.
Yeah, I mean, first of all, that's an all-star summary of of a lot in a short period of time. And again, it is a compressed period of time. I'm more interested in the clock time or in the market time that we're in today. If you take, like in my speak, what you just said was what ended in August and September was quad 3. That's where people crowded into these mega cap, low short interest, widely owned names and crowded into gold. They crowded into plenty of things. Treasuries are big asset allocation mistakes that were made before you really got into, we can say it's the vaccine, we can say it's the data that was led by the vaccine, we could say it's just the cycle. But to me, it's just clean cut. Since November, it's been quad 2. You got growth and inflation accelerating at the same time. For those of you that don't know that, I'm going to say that for the next 3 days. And there's no data to support that that's not happening. So in my world, I wonder how you unpack a couple of these things. Because one, let's do the first one, which is the one that everybody crowded into and actually became momentum. Tesla, Apple, Microsoft were the 3 big constituents of the momentum basket, and that started to blow up. But that's really, to me, that kind of, especially when you think about it in terms of how wide, it was even in the index in the case of Tesla's, in the case of Tesla, which was obviously new. What is it about momentum as a factor exposure coming undone? And let's do that one first, or versus the cycle itself.
Well,
to me, it was a nothing burger.
I think of momentum maybe a bit differently than I think what people in a standard way think about momentum. Momentum applies to wherever there has been the greatest price appreciation. You can have momentum in classically defensive areas. You can have momentum in utility stocks. You can have momentum in treasury bonds. I think what was unique about when we had that momentum in the big 5, the FANG type stocks, what those also represented, though, from a more fundamental perspective, it's obviously where the momentum was because it was very concentrated leadership. That's where all the flows were going. That's where the sort of speculative hype was initially concentrated. But in many ways, that basket of companies represented the COVID version of defensive areas. We have to rethink the labels of things. And when we think about defensive stocks, we typically think about consumer staples and utilities. Yet in the unique period that was COVID, where you found defense, we're in what others would typically think of as growth stocks, high momentum stocks. But in a world where the entire economy is shut down and all we're doing is living in the ecosystem of those types of companies, they became inherently defensive just in a very different way than what we thought of. And then, so these rotations have also been a shift in where momentum goes. And more recently, it's just gone into these maybe more arcane parts of the market, but can very quickly come back into some of those names. You made a point of mentioning a day like today where you've got the NASDAQ on fire and the Russell down and tech and communication services at the top and financials and energy at the bottom. But we could see a flip-flop within a day or two, an exact mirror image, and that's just sort of the nature of the beast right now.
Yeah, momentum, to be clear, we're not on a certain channel where people don't know, the math. Momentum can be growth, it can be value, to your point, it could be anything that's going up. This has been proven over a long period of time where, and again, this is where a lot of people, I think, have been sucked into a narrative on growth versus value, for example. I mean, I'm long a ton of value in the industrial space, energy space, financials. Just to name, actually in the top 4 include basic materials. These are not expensive, momentum stocks. They are higher beta stocks, but these aren't like speculative froth, like paying $60 today for Exxon when in 2018 it was at 75 isn't exactly a bubble. And even if it was a bubble, I wouldn't care. In fact, I would appreciate being long a bubble as it's bubbling up because then you make more money. But I do think that differentiation that you made is something that a lot of people, if you're looking at kind of old Wall's ways, they're stuck with these naming of things. What do you think about that? Growth versus value?
Well, the growth value, I couldn't agree with you more. I think it's important to sort of differentiate between growth and value, meaning the indexes like Russell growth, Russell value, either large or small, and the factors or characteristics of growth and value. I think this will be a value lowercase v driven market. I think investors will be best served by having a bit of a value mindset, but that doesn't necessarily mean put blinders on, look at a value index and say, okay, I need to be in whatever the dominant segments are. And the example I often use, sort of two examples when I explain this to our individual investors who sometimes look askance at me like, well, what are you talking about? I'm not sure I understand this difference between the factors of growth and value and the index labels or constituents of growth and value. But think about October of 2002. So the tech bust had finally ended, the S&P down 57%, NASDAQ 100 down more than 80%. If you were a value-oriented investor, you would have made a killing by going deep value, but by buying some of the most undervalued growth stocks, tech stocks that have gotten absolutely hammered. Russell didn't move them into the value indexes, but that's where you found value. If you had just said buy value at the time and you put blinders on and just bought the indexes, you would have been buying the stuff that's always been in value, like utilities and telecom at the time.
Yeah.
So you wanted to be a value investor then, but the money you made was investing in lower value growth companies. And the more recent example I give is utilities are fairly expensive right now. So they don't offer a tremendous amount of value. Russell didn't move them into the growth indexes. They're still housed in the value indexes. They just don't offer a lot of value. So I think, especially in an environment like this, you can say, yes, focus on value, but don't necessarily box yourself in. And then the other issue here is it's a bit of a chicken and the egg. We've had forces that have been driving financials and energy since their relative lows back in late October, early November. That has been to the benefit of value indexes. The Russell 2000 Value Index has 28% of financials. You get a big move in financials, you're going to get a big move in small cap value. So sometimes the headline is investors plow into small cap value. Well, it's been a few days or a week or month or whatever it is for energy and financials, which boosts the index that holds 28%.
Well, it's bass backwards, as I like to say, in terms of how we do it. I mean, again, we take what economic quadrant are you in, what asset classes you want to be in, factor exposures fully loaded with sector styles, and then back into whatever ETF has those exposures. So to your point, the Russell value, had a lot of what I like, and it also had some energy in there. So, IWN, if you want to look at it that way. We don't start with these definitions, these kind of old wall ways, and I think that if anyone's to take away a lesson from what we've talked about so far, that's empirically it. And let's take a step back to another big one. Okay, in Quad 2, which people may or may not know, and from my perspective, that's the opportunity. You guys pop up the factor exposure table. Things that work in Quad 2, Lizanne, are quite literally toxic. High debt to enterprise value, high short interest, high beta. These factor exposures, when you look at it from my lens, I wonder, if round one, let's go through all three rounds so far of corrections in the U.S. stock market this year. I think it's because people were crowded into factor exposures that they shouldn't have been in. And high short interest in the second bucket there is the most obvious one. How many hedge funds shorted stocks that are trading at 3 to 5 times earnings with 50 to 100% short interest going into the greatest acceleration in retail sales that they will ever see in their career or anyone else's? I don't know. But to me, that's like an avoidable mistake. But it also, again, because it was a mistake by the many in the hedge fund community, it created an episodic and non-trending correction in the U.S. stock market. What do you think about that?
No, I agree with you, and I think the force obviously involved to a great degree in the heavily shorted stocks broadly, with GameStop obviously the poster child, and a couple of different waves and periods of that. Also obviously brings in not just what the hedge funds were doing on the short end of the equation, but the flash mobs of newly minted retail traders that have become an unbelievable force to be reckoned with. Now, whether the majority of them are investing, I would posit that they're not investing based on quad analysis or factor analysis. They're flash mobs, and they're being fueled by social media and subreddit, and have gotten burned in many ways. But there's no question that we have to incorporate that new cohort in the way we think about markets, and we're seeing that hedge funds are forced to do that, whether they think this cohort is operating with appropriate information and data and education. At least in the short term, that's somewhat irrelevant, given what they've proven to be able to do. And I think, I know it's a little bit tangential, but on the subject of that, I have mixed feelings about sort of this cohort. I think it's great because I think many people, even to some degree, myself included, sort of thought, I wonder if we're ever going to entice younger people into the market, into investing, especially given the pains endured during the financial crisis. And sure enough, we have, and there's a confluence of reasons why. Ideally, though, we can transition that cohort from being, in some cases, momentum-driven speculators without a lot of sort of fundamental underpinnings into more educated, longer-term investors without a calamity having to happen in the interim.
Yeah, I agree. I agree with that. I mean, education's the opportunity. On the same side of that coin, I wouldn't poo-poo momentum investing or Reddit type investing relative to anything else. I mean, I think it's as idiotic to be long gold when interest rates, nominal and or real rates are set up to rip like they did. So again, there are evangelicals everywhere. There are gold bugs, there are maxis, there are momentum investors. Like, why is it that we have to sit here? And guess what? Momentum investors, for those of you that are out there, you're going to get eviscerated in what I call quad 4. It's going to happen. But again, I don't think that it's like, okay, if you have your 60-40, let's go back to what you said earlier on that. If you had a 60-40 setup this year, you didn't know that inflation is going to rip to 3% within the next, at least that's what we think, in the next couple months, and that bond yields were going to rip first slowly and then all at once. Like, you just got crushed, being long that old wall portfolio with a complete unawareness of a very obvious thing that is happening currently, which is inflation accelerating.
Yeah, and I've read most of your recent thoughts on inflation. I think we're relatively similar in our views. That I don't want to use the word transitory, which I'm sure we're going to hear from the Fed ad nauseum in the next several months. But we're dealing obviously with the perfect storm of the supply-demand shocks that are inevitable as a result of this crisis. It's part of the reason why we saw the weaker industrial production today. There was weather issues, but it was also supply issues. So I think the supply-demand imbalance is not only likely to cause some inflation price shocks, it's also could muck around with economic data like industrial production because of everything going on in terms of the supply chain. And then we, of course, have the base effects where in year-over-year terms, we're going to start to come up against. And this is both in terms of the inflation numbers we're going to see, but also a lot of the economic data, at least on the services side of the economy. Less so on the good side of the economy because we've had such a strong good side of the economy all along. If anything, the comps get tougher because we're going against a period where the only consumption was on the good side, not on the services side. I don't see really any risk or much risk at all of a systemic, mid 70s to early 80s kind of inflation environment, wage price spiral. That could build into concerns and represent a risk factor in terms of the market perception and what the Fed might have to do. But I think the conditions for a 70s style inflation problem are not evident. I think I don't know if your view has changed on that, but I think you have also a somewhat narrow window of when you think the inflation numbers are going to look really hot.
Yeah, it's a narrow window not to fall out of. I mean, and I think that's a real important point about risk. Again, it happens slowly, then all at once. And you don't have to be Nostradamus, in predicting the 1970s. Hey, we could have it. And you and I can go through what that could look like, fully loaded with MMT and devaluing the dollar 10% from here. I don't know, But at least if you guys pop up slide 15, what we're talking about here is a legitimate shock of going from 0% to 2% to 3% inflation in a short window of time that a lot of people fall out of the window. And if you're too many stories up, long duration, for example, or if you've been long utilities instead of energy stocks, you're going to get crushed, and you have been crushed. So it's that stair step, I don't know if you can see that slide, towards 3%, and that's a quarterly nowcast, and obviously some of the monthlies, particularly once you lap the April base effect, are going to be higher than that. So again, I want to make money. I don't want to make up theories and white papers. So from my perspective, I still don't think that that's priced in. If anything, I think that what you just said is really important. Today's economic data, and tell me if you agree or disagree with this one, today's economic data ensures that sequentially the March and April numbers are going to rip, because you get these weather-related numbers that are, the market's reacting to numbers that they're like, oh my God, the economy's not as good as we thought it was. The February numbers don't matter. It's the super easy comparisons of March and April in particular, and to some extent May.
No question about it. And again, particularly on the services side of the economy, I just think the sort of the pent up demand story is getting a bit too much play on the good side of the economy, or maybe not specifically assumptions that we're going to rip on the good side, but a general view that we're going to see that across economic data metrics. But when you break the economy, the consumption part of the economy, into goods, both durable and non-durable goods versus every variety of services, on the good side of the economy, we more than rebounded to well above pre-pandemic levels, and actually are starting to roll over a little bit. So I worry we could have a bit of pent down demand on the good side at the same time we've got massive pent up demand on the services side. So I also think it may be important when looking at the inflation data to do a bit of that separation between goods-oriented inflation and services-oriented inflation.
Yeah, services, as you know, services inflation has lagged, as it does, and it'll catch up. But you're right. I mean, if you look at the hardest asset of goods that you could have been long this whole time, and I mean since June, it's been commodities. I mean, to me, and I wonder, because you talk to many more RIAs, many more of the people, and I think that that's a huge advantage that you provide for people, particularly on your daily engagement on Twitter. They should be, feel blessed that you're not traveling the world like you used to have to do so with more so the institutional types. But they wake up in the morning to somebody who actually speaks English, on Twitter, and speaks the language of the people. And this is one thing that I think has been a major mistake for people that are actually interested in being long value or not. There's an entire asset class called commodities that was as cheap as it's been cyclically, or from a secular perspective, you can even make that case, that's been going straight up since June. I mean, really since May. And that to me is something that's been missed by a lot of people. And then you get the linear types or the officialdom saying, oh, there's no inflation. But there's epic inflation in your asset allocation, in your account. That's been awesome.
Oh, we've had massive inflation even before we started to see it in inflation expectations. We've had massive inflation in assets. We've had massive asset inflation. So I just think there is a maybe less of an understanding of when we talk about inflation, what exactly we're talking about. But we've certainly had plenty of it on the asset side of the economy. And by the way, if you look historically at periods where you have kind of rampant asset inflation and not real economy inflation, those have been weaker economic growth environments, not stronger economic growth environments. So consistent with what we had, so history is consistent with what we saw in the last expansion. So the last expansion from June of 2009 to February of 2020 had a lot of people cheering because it was the longest in history, which is factually true, but it was also the weakest by a pretty wide margin. And that is a function, I think, a lot of things, but I think the burden of debt is one of them. And back to inflation, I'd say the number one question I get from our individual investors is around debt. But why hasn't it yet, or when will it cause sort of a hyperinflation problem? And I'm not sure that's the conclusion you should come to when analyzing the long-term implications of sort of a high and rising burden of debt. If anything, it acts more as a wet blanket on growth, which in turn has helped keep inflation from running away in not just this recent period, but the last several cycles.
Yeah, people have a hard time with that one. I guess it just doesn't find its way into kind of the fear-based newsletter service or whatever, the book that's written on debt creating inflation. Debt has compounded deflation like more so than anything else.
That's right. Absolutely.
And that's not only just what's happened empirically and most recently when deflation got priced into everybody's portfolios at the lows at negative interest rates. That to me, but it's also something that's happened to all countries. Reinhard Rogoff has written about this historically. Exactly.
Yeah.
But why is that? Like, to me, that's the portfolio that I feel bad for the people on. The retirees that are just decked to the halls in deflation. Gold bugs are in that camp big time. Even though they think gold is for inflationary times, which is absolute nonsense.
Correct.
Gold is great in quad 3 where you have stagflation. That's not
right.
Quad 2 inflation. Quad 2 inflation is nominal rates, real rates up, gold down. Gold just had a 20% crash. I mean, to me, that's what I feel. I feel bad. I mean, I feel bad to have to tweet the daily, like it's like a daily drawdown chart, and people are like, "Oh, you're picking on me, or you're picking on the gold bug." Do you have many of these interactions with gold?
I do, and I'm not a gold expert. I'm certainly not a gold bug, but part of the reason why I'm not a gold bug is I'm not a gold expert. So I think those two are somewhat connected. But I do know enough about history that gold has not been an effective inflation hedge. Gold has generally worked when there is kind of geopolitical uncertainty. And even now it's got, other competitors, including, cryptocurrencies, I guess, for that role. And I'm certainly not an expert on crypto, but gold has not been a consistent or effective inflation hedge. In fact, if you go all the way back to 1900, which is the inception of the Dow, and you look at as kind of CPI-based inflation measures, the only asset class that has outperformed inflation every single decade since 1900 is actually U.S. small cap stocks. And you have to proxy them prior to the late 70s because we didn't have Russell back prior to 1978. So you have to develop some proxies going back. But that's been the most consistent. And then at the sector level, maybe much less of a surprise, energy has been the best sector in these rising inflation periods of time.
Yeah, I mean, it's pretty straightforward. You want to be long of inflation, then be long inflation. Be long commodities, energy stocks, bank stocks that have to do with a steepening curve due to that inflation on the long end, finding its way into the bond market. I mean, to me, it's pretty simple. I guess I get, like you, I get a lot of these questions. Now I put it all live on the macro show, so the queue is, I feel like I'm just carrying old Wall's baggage on that topic. I guess I got to keep carrying the baggage.
There are these, to use your term that you use a lot, old Wall, these narratives that regardless of any actual data that supports it just persist out there. And it's, debt is going to cause hyperinflation, QE or money printing is going to cause hyperinflation. Gold is the best, if not only, inflation hedge. And again, there's just not a lot of historic basis for that. Based on fact, this is not us sharing our own opinion about this. This is not difficult data to actually quantify historically, but God forbid we quantify data.
Yeah, and when you said geopolitical risk, that in many cases has to do, particularly if it's Middle Eastern geopolitical risk that's associated with an oil spike, but a real growth slowdown at the same time. Again, quad 3 stagflation. Gold loves that. Gold has peaked, at least in the last two cycle peaks, during quad 3. It peaked in August of this most recent 2020 edition, and it peaked in quad 3 in 2011 for precisely that reason. You had economic stagflation, and whatever your concerns would have been, geopolitical, economic, or otherwise, that's what gold loves. And that's an empirical fact as well. So thank you for...
So Keith, when do you think we go from 2 to 3?
To inflation?
No, quad 2 to 3.
We haven't taken a peek at quad 4 first, so the open question is whether or not Q4 of this year, and it has largely to do with the Fed. If we see quad 4, the rate of change slow from its cycle peak, and it wouldn't be hard to look at the slide 78, guys, which is the control group of retail sales. I mean, these numbers have gone parabolic. You wonder why hedge funds have lost their fun for being short that chart. I mean, come on, guys. That's the best rate of change acceleration ever. And you wanted to short your favorite shorts ahead of that? Too bad. That was wrong. But again, these numbers are going to go so high. I think that's what we just call a rate of change slowdown from the cycle peak on slide 13. If you just go from up 11 GDP to up 4, 5, or 6, that's cutting the growth rate in half. So again, it's not about the absolutes. So we think we're going to hit quad 4 first, and then it's going to be an interesting battle between quad 4 and quad 3 in the fourth quarter, and it has to do with how engaged the Fed is when they see deflationary forces in markets. And they've been, they look to be ready on that, and that's something that I've had to grow. I mean, I've had to grow up, frankly. I mean, I've had to learn from my mistakes. Almost every single time I'm late to the party, it has to do with the Fed doing more than what I thought they could have done. 2011 is a great example when Bernanke twisted the curve. This time, do you think this could be the most epic of all, or do you think that those expectations are also a little too blown up at this point?
You know what? I honestly have no idea. There are so many unique aspects to this crisis. And now, admittedly, I will often answer a question about the future with, I have no idea. And anyone answering honestly should say, I have no idea, because as fact and data based and objective as we all try to be, we don't know. But in terms of the nature of this cycle, what it looks like on the back end, what the Fed's reaction function is going to be during whatever length of time this inflation spike is going to be, and then adding in some of the newer players like the retail traders. I think it's always difficult to gauge what the market is going to do, but I think even trickier in this time. The one thing I worry about from a macro, not meaning macroeconomic, but from a big picture perspective, is sentiment, which we talk about it all the time. I'm a big believer that defines major inflection points in the market. Maybe even more than a lot of the traditional fundamental indicators. And I believe in your quad analysis. It's similar to the way I think about how the cycle works and the connection between the economy and where leadership is and which asset classes do well or more poorly. But I really do think, purely from a market perspective, that famous Sir John Templeton quote, bull markets are born on pessimism, grow on skepticism, mature on optimism, die on euphoria. I think that's one of the most brilliant things ever said about the market, and possibly because there's nothing in that no word in there that is fundamental in nature, that has anything to do with GDP or interest rates or inflation or PE ratio. It's about the psyche of investors and the extremes of emotions. And I think the biggest risk right now is been bred by the market's success, and that's this sort of speculative excess. But as we all learned in the late 1990s, that could go on for a really long period of time. And sometimes it just sort of falls under the weight of that speculative excess, euphoria, stretched valuations, and other times it's more catalyst driven. Last year, pre-pandemic, I wrote a report in late January of 2020 that I actually titled Virus, but I was positing that sentiment had gotten really, really frothy, and that sometimes you just need a catalyst. Maybe the virus would be it. Little did I know it would turn into the mother of all negative catalysts. So that's what I worry about most, without really having a sense of, okay, what tips this thing? What's the catalyst? Is it going to be Fed driven, or is it something sort of out of the blue? I really don't know.
Yeah, I think those hopefully are frequently used words in the next 3 days. I don't know. I like that. Slide 5, guys, by the way, just shows what Lizanne just said, and that's why we get along. I think we just think maybe too similarly, but on the left side, behavioral psychology of the market, to me, measuring and mapping that daily and contextualizing it within positioning. It's as important as the history and the math of it all. So, thank you for reiterating the same, because at the end of the day, not everybody thinks that way, and I think it's partly due to how we're trained. I have to get to the Q&A because a lot of people are interested in asking you questions. The first one, if you don't mind, is Jim from New Jersey. Hi, Lizanne. Does it concern you that the markets have become largely centrally planned, and that we have not had the reset to normal post the GFC?
Yes, I do. I think that what central banks have done, and not just the Fed, is probably as much distortionary as sort of inflationary or deflationary. It's sort of the other area. And I do think I don't think it's on purpose, for lack of a better way to say it, but maybe an unintended consequence is it does sort of muck with traditional pricing mechanisms. I also think, and this may be the more interesting thing to think about with regard to the Fed. I think pre-pandemic, when Powell, I went to one of the lunches he did at the Economic Club of New York. It was in December, and his comments during that lunch received a lot of attention because he basically backtracked from what he had said in September of 2018, which contributed to what was the near bear market in the fourth quarter of 2018. And he basically realized, okay, I've got to use my words maybe to sort of right the ship. But what I found interesting about that talk then, it was the first time I heard him emphasize it, but he's touched on it since then, that I think all investors need to be mindful of, is in essence, back then he said, the Fed needs to be mindful of financial system stability, which is to be distinguished from financial market volatility. And I think that was really important. I think what the Fed has done in most of these cases, certainly last year, was not because we were dealing with instability in the financial system, but what had started as a health crisis became an economic crisis. The Fed wanted to prevent from becoming a financial system crisis. But simple market volatility, a corrective phase, a severe correction, bear market or near bear market, in and of itself shouldn't be seen as ernoughh of a trigger to cause the Fed to step in. So I need to think we need to back away from sort of the perpetual Fed put, the Bernanke put, the Yellen put, now the Powell put. And I think we may need to sort of see a test of that, where if we go into a period of financial market volatility that has nothing to do with the system, whether the Fed tries to directly or indirectly pull people away from this view that the Fed's got the markets back no matter what. So that to me is one of the ways to think about the Fed in the next quarter, 2 quarters, 3 quarters, year, whatever it is. I'm always listening to hear if Powell continues to emphasize that.
That answer is interesting within the second highest upvotes. By the way, your questions get voted up or down. And this question from Darren in Naples, Florida, is along those lines.
Where I am.
Yeah, there you go. I think that might be your neighbor. Might be the guy who got the dogs to shut up. Look at that.
Got the dogs barking. Maybe he's standing out in the back, like trying to knock on my screen door.
He's got treats. So Darren in Naples, and this is a really interesting question. You touched on parts of it already in that last answer. Will we ever see a return to a public determined market, or is the Fed trapped in the market for good? That's to me too, particularly now with C.C. Rouse, Janet Yellen. It's not just the Fed. We're going to combine the Fed with the Treasury. And I'm not so sure that C.C. Rouse, a labor economist, and Janet too, these are both labor economists, are in it for Wall Street this time like we've seen in the past. So I think about that a lot, actually.
I think you're right. In fact, I don't think there is much in it for Wall Street. I think there's a Wall Street and many investors' perception that the Fed's got the markets back. But I think certainly what we're seeing with Powell is more of a direct focus on the Main Street economy. And I also think what's interesting about what Powell has been focusing on lately, especially in the pressers after the FOMC meetings, is this not so subtle shift in the way he describes the Fed is or should be thinking about the employment mandate. So there's been so much focus on the inflation mandate with the change last year to the target being an average over time, the allowance to let it run hot because it's run cold. But he's also been talking about, and I'm using my own words here, sort of a quality and breadth when it comes to employment. So it's not just simply a decline in the unemployment rate to, whatever the dots plot says, but what is the makeup of that decline in the unemployment rate? Is there breadth across segments of the economy, across, income brackets? So without making a formal change, he has been emphasizing that in his mind anyway, that's what he wants to see. So I think we have to rethink both mandates. But I do think that there has been a little bit of a shift where the Fed seems more than in the past couple of cycles as focused on Main Street. And I agree with you. There is this melding. Maybe it's not under the formal confines of MMT as it was originally discussed, but in many ways, sort of we're all becoming MMTers within the political sphere and certainly the Fed.
Yeah, there is a lot to think about there. And again, the I don't know part, I'm with you on that. It's just that the components have changed and changed meaningfully. And at this point, it's going to be interesting to see play out. I'd say, again, like what you just said, which is beware of the Ides of the former March, where you think that it's just going to be what it was, your former Wall Street bailout. I highly doubt that. I mean, bailing out junk bond holders this time, I doubt it. But
I'm going to have to. I've got a number of these all day, but I'm going to have to jump back in and watch what I think the next two today are Mike Green and Grant. Is it Grant Williams too?
Yep, both Grant and
Green. Grant's podcast series with Bill Fleckenstein on the Endgame that has had Mike Green as one of the guests has been just fascinating. There's so many different perspectives on what the end game looks like. They've talked about it a lot with, do the printing presses get taken away? Does the bond market take the printing press away from the Fed? And then you have the more benign view that maybe we just, inflate our way out of this. It is fascinating to think about what is the end game to so many experiments we're doing right now on the fiscal side, on the monetary side. And I can't be so naive to think that there isn't a reckoning at some point. It's just hard to. Is it some threshold of debt? Is it some moment in time? It's just I'm as flummoxed, I suppose, as everybody else.
Well, I think on that we're running out of time, and I definitely want to get to this last question because it has to do everything with that. This reckoning, the bubble. I think anybody with any level of experience that, by the way, has seen the wreckage. Don't forget that people our age have seen the stock market collapse big time twice. So people have that baggage. I think a lot of people have missed the move in asset classes as a direct function of their baggage. So I do think it's important to have a balanced scenario analysis on that, and just so that you're aware when you're in it. It's not unlike navigating a fishing boat or anything like that. I mean, you have to be aware of the scenario analysis and not just be wed to one path. And to me, that's why I love these conversations, because I get an education on what other people think is the path or the multitude of paths and the multitude of probabilities. This last question has to do with that. I mean, this is from Jordan. If somebody knows the answer to this, it's you. Has a high PE stock market ever corrected by increasing earnings, or is a crash always inevitable?
Well, we've never seen components of the PE story quite like we have in the last year or so, where the spike up to 2000 level PE ratio came because of the collapse in the denominator.
Right.
So that's certainly the big difference between what was a 27 PE in the current environment and a 27 PE on the overall S&P 500. Back into 2000, prices were rising, so were earnings. Earnings were rising into ultimately a peak, which we didn't necessarily know at the time. In this case, we've seen the collapse in the denominator cause the biggest part of the problem, which is why when you recently rolled into adding another prospective quarter into the 4 quarters representing the E in the forward PE, just the improvement was enough to bring the S&P's PE from 27 down to 22,
right.
Literally overnight. So the compression in earnings and then the subsequent rebound we're inevitably going to get because of the comps, we've never seen that before. So I can answer honestly, no, we've never had this exact experience, but the only time we've ever been at that type of multiple was in 2000, which obviously the correction of that came with a 2.5-year brutal bear market. So far anyway, the denominator is kind of doing more of the heavy lifting, which also solves valuation problems like the Buffett model. Overall market cap of the entire stock market relative to GDP or GNP. There's different versions of it, but we're going to get an improvement in the denominator of that equation. So many that were pointing to that being in even more bubble territory as what we had back in 2000, will see it start to come down by virtue of that pickup in the denominator.
And of course you nailed the answer to that question. You're the empirical person. You're gonna be the most specific on a direct question like that. And again, if you get, I always say this, valuation is not a catalyst for a stock market decline.
Right.
If we get a rate of change slowdown from a cycle peak in earnings, now again, that goes back to the year 2000 that you mentioned, that is very causal in nature, and you can think about it just like your favorite stock. What if and maybe this is the problem with Amazon, by the way, maybe it's the problem with all these widely owned COVID recipients. They have very difficult COVID comps. What if they slow their growth? What if Bezos left because he knows it's going to slow? I mean, there's a lot of different obvious things that could be brewing here in consensus and long-held positions that might just wake you up to saying, hey, look, the market's got it right because they got the rate of change of earnings right. So we'll have to see about that. But again, thank you so much for being like the leadoff hitter. You crushed it as I expected you would. In fact, you crushed it even further out of the park than I thought you would.
Thank you. Well, I look forward to watching the rest of your day. I'll have to watch it in replay fashion because of my day, but it's fascinating stuff you've got coming up next.
Well, thank you for saying that. And thanks for making our day better, Liz Ann Sonders. I knew she would. That's a layup. I always go with layups. I'm 5'9". We'll be back.